Good evening, everybody. It is Friday, June 27th, 2025. Today, we begin with our episode with income and spending turns negative as PCE comes in a little hot. While personal consumption expenditures headline numbers came out as expected both month over month and year after year, the core came out just a bit hotter than expected. But the more notable part of the same report that sometimes gets lost is the personal income month over month, first time negative in years, and also personal spending coming out negative, while both were expected to be positive. The last time U.S. personal income month over month was negative was all the way back in October of 2021, with this June month reading of being negative 0.4%. The cracks in the economy are getting louder and more frequent. So with PCE and income sort of canceling each other out inflation-wise, we didn't really see much change in the Fed funds futures, nor the break-even inflation expectations. And with the stock market essentially getting to all-time highs today, so across the board, we were able to keep the status quo. And this helps with window dressing, as tends to happen at the end of a month. Of course, Monday is actually the last day of the month and the quarter. But today being the end of the week, we're close enough to that period for this to have a little bit of an effect. And what this means is window dressing, a lot of fund managers they want their clients to make sure that they see, oh yes, you do have Nvidia stock, yes you do have Netflix stock and this stock and that stock, all these stocks that went up so much this year. Of course they're in your portfolio, as they buy them last minute to show them that they are currently in their portfolio. You get all sorts of nonsense going on at the end of the quarter, and that's partly why I think markets are not cracking to the downside yet. I think we're going to have to wait, honestly, till Tuesday, the beginning of July, before we start seeing any of that, if it's going to happen. I think it's going to happen, but we'll see. Next, moving on to community topics, Robschild takes a break. What? Robschild, you've been doing daily shows for forever. Well, if you've been a fan of my show long enough, you know I do a little bit of traveling over the summer. So my shows, I will put out as many shows as I can. They might be a little more intermittent. The quality's going to change. I'll have a little different equipment. I'll try to get in as many shows as I can. But this is the last regular show for a few weeks. Next, coming up, as always, tariff updates and still federal budget updates. It sounds like the tariffs are finally getting back into the news a little bit, with updates in Canada and China today. And then scrolling through the calendar for next week, on Tuesday, we have the job openings report, which can be a really big one, is an important part of the beverage curve. This is a huge piece of what allows the Fed to make the decisions that they make. ISM manufacturing is fairly important. You got your ADP employment. And then Thursday, besides the regular initial and continuing jobless claims, like I said on yesterday's show, continuing claims going parabolic to the upside. We'll see if that still happens next week. We have the employment unemployment report, very important report. How many people want jobs and can't get them? Last month's was 4.2%, and it's expected to rise a little bit to 4.3%. See how that comes out. You can't have a recession if you don't have lots of people saying, hey, I need work, and they can't get it. It's a major part of if we are in a recession or not, despite if we have the negative GDP, as you found out yesterday. It was revised down, by the way. Again, I'm amazed, 3 points, I guess, or 30 points, right? From negative 0.2% to negative 0.5%. It stinks I'm going away for the next few weeks, because I really feel like we're on the edge of a cliff here. But at the same time, Mr. Market's sitting at all-time highs, and it's like not worried about a thing. Amazing times. Anyhow, thank you so much for watching, subscribing, commenting, and supporting. Your subscriptions, your comments, support, and views are much appreciated. Two small updates on the daily reminders macro views, or three of them actually. I just put them at the bottom here because I didn't have them here before, and I'm going to have to update my website hopefully this weekend if I get it in. Q1 GDP, negative 0.5%. It's an important part of the macro view that I think that we need to remind ourselves on a daily basis, not on a once in a while basis, on a daily basis. This is our situation we are in right now. Again, never any advice, but this is the way I see things. Secondly, June 2025 personal income negative for the first time in 3 years, basically. And also, we are having our, next first cut, right, in September of 2025. Once the cutting cycle begins, that's very frequently a time when a recession starts. So hold on to your hats. I'll try to get this all updated on my website ASAP. No changes to the crystal ball ratings nor the Robschild portfolio. Moving on to some charts, starting with SPX, the S&P 500, how there's no other way to see it other than we are at a closing all-time high in the stock market. Again, this is really helpful for window dressing. Your regular investment advisor can now print out his report and send it out gleefully saying, yeah, look at how great we did this quarter. Meanwhile, all the cracks below the surface are just looming, the tariffs, just forget about all the problems. The markets are at all-time highs. Amazing. I feel so much vertigo at this level. It's literally making me nauseous when I think about it too much. TLT, my favorite place to be. Unfortunately, this pattern that I had, what happened to this channel? It got a little messed up here. I don't know what happened to it, but we dropped back into it. There, I fixed it. We dropped back into it today. Intraday, we were actually above yesterday's candle, and we are back inside it. It kind of negates the power of this channel now. It kind of suggests that this line doesn't have a lot of strength to it. But one thing still giving a good amount of strength, in my opinion, to TLT going higher, again, is the 10-year Treasury note yield still looking plenty bearish, rising today a little bit to 0.7%, but this is not a turnaround by any means. It still appears that we are headed down at least to the 4.13%. Now, along with Mr. Market getting just so complacent here, we have credit spreads staying the same as yesterday. Basically, HYG divided by SHI dropped by 0.01%. We're basically at 3% spread between junk bonds and treasuries right now, which is complacent zone. It suggests people are willing to put their money in higher risk. They're willing to lend their money, not just buy stock, but lend it. As in here, you borrow my money and you pay interest on it. They're accepting a very small amount of extra yield than what you can get from treasury securities. When it's only 3%, that's a humongous warning bell complacency sign, and we're just ever so tight in credit spreads. Next, I wanted to bring up crude oil, only because that $65 barrel mark that has sort of a history as a psychological level that goes back all the way to 2022, 2021, and one that we broke and stayed below for a while. After this whole scare of potential oil shock in the Middle East with oil rising recently, we went back straight down. And everybody wants to know, where is crude oil going from here now? Because it's very important, because it's going to say where yields are going. It's going to say, if oil really takes off to the upside for where we are right now with all this other data coming out, you want to see the labor market get a a lot weaker, a lot faster, and watch crude oil go up. Fortunately, crude oil does not look like it wants to go up from here. This is very clearly a very strong bear flag. We were unable to cross down below 65, but we've knocked on it with this collapsing candle on Monday, hitting it 1, 2, 3, 4, 5 times every day this week, Monday through Friday. We've been knocking on it. This is very clearly a very clearly a bear flag. This has more probability to break to the downside than for it to continue higher. So this is what I'm fully expecting for the moment. Gold caught my eye today, dropping 1.6%. Traders better than myself are expecting some support to be at the 3,100 level and eventually the 2,900 level. With some uncertainty sort of going away, gold is allowed to not continue just pumping higher and higher. For people or institutions currently buying gold, the idea here is that it's a fear of the dollar losing value and the idea that gold can hold its value. So these fears are dissipating a little bit. Silver also caught my eye today. Let me show you this real quick. Pretty clear head and shoulders pattern here. Looks like we're headed lower for the short term. I know some people are looking to accumulate between $32 and $29. SMH, the Semiconductor ETF, Semiconductor Index, rising tepidly. You know, these two little dojis in a row, these are not strong bullish candles. I mentioned this, I think it was yesterday, how it looks like, you know, we're getting less and less momentum to the upside, and it doesn't look like a strong bullish movement by any means. And the fact that we haven't reached all-time highs in the SMH, and yet in the triple Qs we are at all-time highs, and in the S&P 500 we are at all-time highs. You know, if the markets follow the semis as they often do, this could potentially be a top in markets, but you never know. Mr. Market's a crazy guy. Who knows what he's going to do? That's all for today's show. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.